Good morning, everybody. Welcome. Call this meeting of NCUA Board to order. I want to welcome some leaders in the audience. Go West Credit Union Association, some of the CCUA, my fellow Patriots fans, League of Southeastern Credit Unions, and I think there's at least one or two people from ACU here. In addition to those joining us in the boardroom, I want to note for the record that today's meeting is open to the public through a live webcast as well. For those watching online, if you want to view the closed captioning, please click on the CC icon in the lower left corner of the WebEx window. We have two items today. The first is the quarterly briefing on the Share Insurance Fund. The second is a briefing on NCUA's voluntary separation programs. There's been a lot of speculation about our voluntary separation programs in the media, credit unions, even within NCUA. While the agency has made every effort to keep staff informed and everybody else informed since the rollout, anything of such importance and sensitivity is bound to generate rumors. Today, we're going to provide more clarity on the VSP. The upcoming presentation is an evolution of the version originally scheduled for the canceled April board meeting. Today's presentation will provide the public with more details about the program and a clearer picture of the path forward. Before we go to the briefings, I want to highlight a couple of events in the last couple of months. By now, you know, new charters are one of my priorities. Credit unions are the original answer to the challenge of financial inclusion. I want to commend and congratulate the organizers of Heritage Hub Federal Credit Union in Houston and, just last week, African Diaspora Federal Credit Union in St. Louis, just like the very first credit union in America formed by immigrant groups. There are our first two federal charters of 2025, and both offer the promise of financial security and well-being to their communities. These groups are doing what Americans have done for over 100 years, starting their own credit union since they obviously weren't entirely satisfied with the current financial services marketplace. The number of credit unions in America and the number of new credit unions needed should be a matter decided by Americans, not by anybody in government. And it goes without saying that the best consumer protection is a competitive marketplace. The organizers of those two credit unions worked alongside members of NCUA's CURE, Credit Union Resource and Expansion Team, and I want to appreciate the efforts of NCUA staff in moving these applications through the process. To that end, it's important that our process at NCUA facilitate rather than impede the formation of de novo credit unions. The agency has made strides in reducing the pain points for organizers to apply for a charter in their communities, and I appreciate the hard work of NCUA, my NCUA colleagues in this process. The agency always has to adapt and improve, just like the credit unions that we supervise. And next piece of good news, in end of March, NCUA released Valwood Park Federal Credit Union from conservatorship, thereby returning control to its member owners. Placing a credit union in conservatorship is a difficult decision, and it's one that we don't take lightly. Thankfully, conservatorship is not a one-way street. And Valwood Park and NCUA's Southern Region deserve acknowledgement for taking decisive action to save that credit union. Once a credit union leaves the community, rarely does anybody come to fill its place. Putting a conserved credit union back in the hands of its member owners is a financial redemption story and a testament to the hard work of new management, their staff, and the member owners to bring your credit union back from the brink. So congratulations to everyone involved in that effort. First item on today's agenda, Share Insurance Fund. Staff presenting Eugene Feed, our CFO, Eugene Sheep, and Melissa Loudon, Deputy CFO. Good morning, Eugene and Melissa. Begin wherever you wish.
Good morning, Chairman Ottman. To begin my quarterly update, I'll acknowledge the NCUA team that contributed to our being recognized last night for excellence in accountability reporting from the Association of Government Accountants.
Did you go to that event?
I did.
The big accountant dinner? That must be the best party in town.
Yeah. We call it the accountant's prom.
Yeah.
All dressed up, white tie.
That's terrific.
Tie,
excellent. Yeah. No, that is good work. I know that's they don't give out too many of those.
Yeah. And so we were honored. It's our 8th one that we got, and we also received a special best-in-class citation for our informative analysis of systems, controls, and legal compliance reporting. I didn't even know there was such a thing until we won it last night. So in particular, I'd like to thank staff from the CFO's office and the Office of External Affairs and Communication who contributed to the award-winning effort. Shifting now to my quarterly update, this report marks an evolution in our public reporting. We are now providing a narrative summary of key highlights that I will use for the foundation of my comments this morning. This provides an overview of the most important points that stakeholders should understand about the financial condition of the Share Insurance Fund. In addition, we have migrated the slide deck into a more informative dashboard that, in addition to providing important data about the fund, provides greater context. Melissa will provide an overview of the new reporting that will be available to stakeholders. I'd like to provide recognition to several team members in my office that took up the challenge to modernize the presentation in terms of both its substance and style, so thank you to May Sue, Susan Carter, and Nardo Acevedo. We will also continue to publish the monthly SIF financials in their traditional format. Looking at the executive summary of today's presentation, the fund reported $79.8 million in net income during the first quarter of 2025. Net income increased $1.2 million, or 1.5%, over the fourth quarter of 2024, and $11.7 million, or 17.2%, over the prior first quarter from 2024. The fund's total assets increased to $23 billion. The quarterly increase was primarily due to $305.9 million in capitalization deposits receivable from credit unions from the traditional true-up process that we do every spring, as well as $296.1 million reduction in unrealized investment losses and net income. The fund records a liability consisting of general and specific reserves to cover actual and potential future insurance losses resulting from credit union failures. At the end of the first quarter of 2025, the reserve balance was $242 million, an increase of $5 million from the previous quarter. The quarter-end balance consisted of $9 million for specific reserves and $233 million for general reserves. The total increase of $5.4 million in reserves from the previous quarter was primarily attributable to $3.9 million increase in the general reserve and $1.5 million increase for the specific reserve. The equity ratio was 1.30% as of December 31st, 2024, which was an increase of 2 basis points from the June 30th level. The projected equity ratio for June 30th, 2025 is 1.26%. This decline is due primarily to forecasted insured share growth. Insured shares for this forecast are projected to grow year over year from June 30th, 2024 to June 30th, 2025 by 5.30%. There were no credit union failures during the first quarter that incurred a loss to the fund. The equity in the fund was such that as of March 31st, the fund could have withstood a loss of $1.3 billion without dropping below the 1.20% equity ratio threshold that would necessitate a restoration plan. Concerning the fund's portfolio, the yield is 2.60%, up 10 basis points from the fourth quarter of 2024. The fund continued to maintain a sizable balance in overnight investments of $5.6 billion in the event that liquidity is needed and would be accessible without incurring a potential loss to the fund. During the first quarter of 2025, 8 Treasury notes matured for a total value of $650 million. These securities had yields ranging from 0.29% to 2.08%. The proceeds were reinvested at higher yields during the quarter, which offset a small decline in the overnight rates. By using the latter approach, the NCUA enhances the fund's long-term earning stability, which will maintain higher earnings in the event of a lower interest rate environment. Finally, addressing CAMEL's data, it's a measure of the fund's risk exposure, and the aggregate CAMEL's data did not significantly change during the first quarter of 2025. The total number of credit unions was 4,415, a decrease of 52 from the end of the fourth quarter 2024. The percentage of insured shares by CAMEL's Code 1 and 2 category was 90.8%, which was a slight increase from 90.2% at the end of the fourth quarter. CAMEL's 3 category was 8.2%, a decrease of from 8.9% in the previous quarter. And finally, CAMEL's 4 and 5 category was 1%, an increase from 0.9% at the end of the previous quarter. Over 90% of the insured shares were in Camel's credit union's Camel's Code 1 and 2 category, supporting the conclusion that the fund is in overall strong financial condition. I will now turn the presentation over to Deputy CFO Melissa Loudon to discuss the new reporting format.
Good morning, Chairman Hoffman. As Eugene mentioned, we're delighted to introduce the new Share Insurance Fund Financial Dashboard, which we see as a significant step forward in enhancing our financial transparency and decision-making capabilities. The dashboard design is partially inspired by common questions posed by NCUA leadership and stakeholders, and will continue to evolve the content as information needs change. The tool offers intuitive access to the fund's financial data, moving beyond static reports to provide a vibrant and interactive view of fund performance. If we can please direct our attention to the screen, I'll discuss a few highlights of the tool. The Summary tab provides much of the information that Eugene covered and features key financial performance indicators in a at-a-glance type format. From here, the user can use the menu on the bottom of the screen to navigate to any tab in the dashboard, and you can see at the bottom the cursor is going across there. The next two tabs show revenue, expense, and asset information using enhanced data visualizations and extended data trend lines. So placing the cursor on this tab on a data point in the graph reveals an informative bar chart that shows what makes up the balance. So here you can see the investment income and other income bar charts associated with the total income numbers. Okay, next we'll go to the Reserves tab, which features graphs that trend the total reserves, the number and size of credit union failures, and any associated losses to the fund. The interactive feature on the top left graph provides the user with a breakdown of the general and specific reserve components of the balance. The equity ratio and normal operating level have their own tab, which also includes helpful information on insured shares. Data trends here are presented across a 5-year timeline. Let's move to the Portfolio tab. This covers Share Insurance Fund investments to include maturing balances, unrealized gains and losses, and yield comparisons. In the bottom graph, users can easily access detailed rate values by placing the cursor on a data point. The last tab we'll cover is the Camel's Overview tab, which depicts the insured shares and number of credit unions by Camel's rating over a 6-year trend line. Eugene and I would like to extend a huge thank you to the team behind this dashboard. Their dedication, collaborative spirit, and expertise were instrumental in bringing this vision to life. It provides NCUA and the board with actionable insights for more effective oversight and stewardship, all in support of maintaining a financially sound share insurance fund. This concludes our presentation, and we're happy to answer your questions.
Thank you, Melissa and Jean, for the presentation. I want to particularly acknowledge the presentation format. Presentation is a form of communicating. Shout out again to your colleague, Mei Su. Did a great job with that. The aesthetics are nicer as well. And that interactive ability where you can hover over the public on our website. Can they do that today, or is that coming soon, or what?
So coming soon, hopefully. Right now, the public version of this is it's an output file, so that interactive piece isn't functioning, but we'll be working with OCIO to see if that capability is available for us.
But as we sit here right now, everybody can see those slides
Yes.
right there.
That's correct.
And then coming shortly, there'll be that interactive bit. Okay. All right. It's good to know the fund remains strong. Like you said, net income about 80 million. That's a increase of 1.2 million from the prior quarter. Assets increased 3%. That's not a good thing. We're now about 23 billion even. No failures, like you said. Broader sense, economic conditions are fairly solid. Employment total is still rising. Wages are growing. We're still at 4.2% unemployment. It's been that way since about last summer. Inflation's retreated from its peak in mid-2022. We've eased down to 2.3%. That's the lowest level in 4 years. That's good. And on a related note, the interest rate gyrations of recent years seem to have subsided. As we sit here, the market expects the most likely scenario to be the Fed lowering rates by 50 basis points by the end of this year and another 50 by the end of December 2026. It's 100 basis points until Christmas 2026. That's a manageable scenario for credit unions, one they've dealt with many times. The economy may be facing some downside risks and uncertainty may be elevated, but credit unions have dealt with today's environment and much more in past decades. Ultimately, the credit union managers and boards of directors must continue to exercise patience, flexibility, and sound balance sheet management to prepare for a variety of interest rate scenarios and economic conditions. You had the treasury yield on there? I'm sorry, our average weighted yield? Was that on there, the SIF? About 2 point, it's edging up, right? It's about
Yeah.
2.6%.
2.6.
I think last time we sat here, it was 2.5.
Five, yep.
And you could just describe the dynamics, right? We spoke about this last time, but
Yeah.
people for a few years now have gotten used to numbers with 4, maybe 5 of easy money.
Right.
What's the Fed at, 4.25 right now? You know?
Right.
2.5 is lower than that by a fair bit. Can you explain that dynamic?
Yeah, sure. So we do have a good chunk of the fund, about $5.6 billion in the overnights, which is earning that higher 4+% each night. Most of the funds that we put into the portfolio, as you can see in the upper left-hand corner of that slide, are into the ladder. So right now, the ladder's out to
Yep.
the 7-8 year bucket. Policy allows us to go out to 10 years. And the reason behind the ladder is to provide long-term stability.
Yep.
When as you can see from the bottom graph on the comparison, the SIF is the blue line. When interest rates were really low, the SIF was outperforming what was currently available because of the ladder approach. The converse of that is when interest rates suddenly spike up, the SIF yield in total will be a little bit lower. But it provides, as you can see from that chart, a consistency over time. So when there are economic downturns and there's more pressure perhaps on the credit union system and on the fund, there is stable earnings.
Yeah. Long story short is that we had that period where we were like Japan for a bit, where I think the 10-year was at 0.7 in 2020.
Yeah, our overnights were
There was a
zero.
huge refi boom. 2.6% is about where my mortgage rate is. The difference between us and my lender is that my lender is on the hook for 25 more years.
Right.
I'll mention to people who talk about that yield, 2.6, you want it to be higher. But when it comes from credit unions, one thing that's universally true, and I ask, okay, in 2020 and 2021, when rates were real low, where'd you lend money? Because we're lending money on an average rate of 2.6 right now, right? Now,
Right.
and then, so when your members came to you and wanted to refi, you said no? Then you look at their book, and when rates were low, you lend money at low rates. When they're higher, you lend them at higher rates. I've never had any critique of this from anybody in the credit union world where if you didn't turn around and look at where they lent money at that time, it wasn't exactly the same. But the difference is theirs are often much longer. It would be interesting to see, say, car loans over time from credit unions, something at similar duration. If we had that, I remember we talked about, it'd be neat to have it. I don't know if we have the data, but we're lending money, which is what you do when you buy treasuries. You're lending money to the U.S. government. Is our management of that different than credit unions as a whole? Because they shoveled money out the door at extraordinarily low rates, often for much longer periods. Anyway, that was just a note. And last thing I'll say, just big picture, remind for me, how big of a loss could we sustain today before we fell below our congressionally mandated 1.2? And as a reminder, when we fall below 1.2, Congress mandates us to put together a restoration plan, which can include and would include, if things didn't change, sending a bill to all the credit unions to top up the fund. This is what the FDIC had to do 2 years ago after the failure of Silicon Valley Bank. How many dollars are we away from that? How big of a loss can the sustain before we even have to do any sort of restoration plan?
Sure. So as of the end of the first quarter, March 31st, we estimated that would be about $1.3 billion. That number does fluctuate just depending on where we're at in terms of the collection cycle with the capital deposits in particular. I think when you asked me this, sometime late last year. The amount was a little over $2 billion, so it does sort of fluctuate. But as of March 31st, we could have written a check for $1.3 billion and still been above the 1.20.
So if a credit union with $2 billion, which would be in the higher, 80 percentile, whoever it is, credit union with $2 billion in insured shares collapsed tomorrow, and it had a 60% loss, which is higher than normal for these
Right.
things, right? A lot of our conservatorships don't cost a cent, and the
Right.
ones that do, it's usually a fraction of the total. But we have a $2 billion credit union, and 60% of their insured deposits are gone. We could pay that out without having to talk to the credit unions of America to top it up, right? Does that be-
Right, yeah,
that'd
we'd still
1.2
be
billion.
above the restoration.
All right, thank you both.
Thank you.
Next item is a briefing on NCUA's voluntary separation program. We've got our Larry Fazio, your executive director, and Amanda Parkhill, the deputy of Office of Examination and Insurance. Good morning. Begin when you're ready.
Good morning, Chairman Hauptman. Amanda and I are here today to brief you on the NCUA's Voluntary Separation Program, or VSP. Through Executive Order 14210 and the related implementing guidance issued by OPM and OMB, the administration directed agencies to engage in, quote, large-scale reductions in force. The NCUA determined a voluntary program to incentivize departures in 2025 would likely meet our downsizing objective and be more cost-effective and less operationally disruptive than a traditional involuntary reduction in force, or RIF. The VSP was approved by the NCUA board on March 21st, 2025. By the way, if we could go to slide 2. Just to repeat, the VSP was approved by the NCUA board on March 21st, 2025 as part of the agency's plans to follow the administration's direction. The enrollment period for the program opened on March 31st, 2025 and closed on May 5th. And I would like to acknowledge there was a large cadre of staff that worked on this program to be able to present it to the board for approval. So there's too many to name at this point, but it was a large group effort.
Sure was.
And so thanks to everybody who was involved. If we can go to slide 3. We set out to achieve a headcount reduction of 20% by the end of 2025 and do that in an orderly way. We'll provide details momentarily on where we stand on that. But before providing that detailed update, it's important to note that 2025 is a year of transformation at NCUA. Some changes are happening quickly, and some will unfold over the rest of the year and into 2026. We are able to continue operating effectively, and the overall headcount reductions we'll be seeing throughout the remainder of the year are manageable. We've been engaging staff in streamlining and efficiency ideas. We've been promoting teamwork and collaboration across offices, and this includes using people with the requisite skills in new roles for higher priority areas or to address peak workload periods. Such efforts reflect better prioritization, better teamwork, cross-training, and so forth, and should not be misconstrued as the agency being unable to continue to meet its mission. The headcount reduction will facilitate transition to a new, streamlined future state for the agency. The new future state will focus on the NCUA's core mission, maintaining service to the public, and achieving the administration's priorities. We'll do this through efficiencies, better prioritization, more teamwork, and use of technology. I would also note the agency operated effectively with about 1,000 employees as recently as 2008, when we insured thousands more credit unions than we do today. To be fair, the institutions today are larger and more complex on average than they were then, and there generally are more requirements imposed on federal agencies, including NCUA now. However, there are certainly opportunities for streamlining and greater focus on the agency's core mission that will allow the agency to continue to operate effectively with a smaller workforce. Examples include amending or eliminating any tasks and projects that are unnecessary or low value, updating regulations and implementing revisions to delegations of authority, making prudent adjustments to exam schedule policy, modifying office operating procedures and workflows to streamline tasks, and leveraging technology such as artificial intelligence tools to promote operational efficiencies. And I'm pleased to note that we've already implemented some changes on all of these fronts. For example, we've streamlined some approval processes and provided regional directors with more flexibility to extend the time between examinations for very healthy and well-run credit unions. And again, we've engaged all of our employees and offices in identifying ideas to help the NCUA be more efficient and more mission-focused. And we continue to welcome such input from our staff as well as other stakeholders. We can go to slide 4. Before we go into some details about the VSP, we're going to start with just a few definitions and acronyms up front. VSP obviously stands for Voluntary Separation Program. VERA stands for Voluntary Early Retirement Authority. That is a longstanding federal government authority that's run by OPM to allow individuals who meet the qualifying criteria to retire early under certain situations, like when the government is trying to downsize. The next acronym is NVSIP, which stands for NCUA Voluntary Separation Incentive Payment. VSIP in the government is actually also a longstanding government-wide authority that's administered by OPM. And with NCUA's additional pay authority, we can actually modify and add to that. And so the program we're going to be talking about here is a NCUA version of that program. And that is generally used to incentivize people who are retirement eligible to retire. And that has actually been used at times in the past, not only government-wide, but here at NCUA. And then the last one is NDRP, which stands for the NCUA Deferred Resignation Program. Sometimes also you'll hear us refer to it as the DRP, or Deferred Resignation Program. We can go to slide 5. So the VSP was designed to incentivize departures in 2025. Under the program, the last day of employment with NCUA for participating employees can be no later than December 31st, 2025. As the NCUA's fiscal year runs from January 1st through December 31st, this lines up with the NCUA's 2025 budget cycle. Of course, participating employees can choose to end their employment with the agency before December 31st, 2025, and some, in fact, have. The agency was very clear to employees this was a voluntary program. The voluntary is right in the name of the program. And we were very explicit that employees would not be encouraged to participate, nor would they be encouraged not to participate. It was neutral. It was purely their choice. The VSP was designed to have up to 2 enrollment periods. The enrollment period for round 1 opened on March 31st and closed on May 5th. Round 1 was open to almost all employees, and the number of participants was not capped. Round 2 would have only been offered if the number of enrollees in round 1 was fewer than 217. And as we'll detail here in a moment, the enrollment for round 1 exceeded 217, so there won't be a round 2, and we're going to focus on explaining round 1, therefore. But to suffice it to say, round 2 would have only been for employees eligible for early retirement under OPM standards for VERA and who also didn't participate in round 1. And it would have included a separation incentive payment of $50,000. So we go to slide 6, round 1 options. So round 1 offered 2 mutually exclusive options for eligible employees. Option 1 was the Deferred Resignation Program, or NDRP. And that provided employees the ability to go on paid administrative leave until their departure, which could again be no later than December 31st. Option 2 was a voluntary separation incentive payment of $50,000, and that was only for retirement eligible employees. If an employee was eligible to participate in round 1 of VSP, they were accepted. And so we did not reserve the right to exclude any eligible employees from round 1, and we did not deny any applications for eligible employees. To participate in the VSP, employees were required to sign an agreement with the agency that memorialized the terms of the program and release the agency from any claims through the date of the agreement. The benefits offered to all VSP participants included, we waived any continuing service or relocation agreement stipulations. And we also allowed all participating employees to continue to telecommute up to 8 days of pay period, which was the case before we had the return to office mandate. And those employees that were in remote duty stations could continue to work from the remote duty stations. For option 1 in round 1, the NDRP, this option was available to all employees with only a few exceptions like board members, so Kyle, you couldn't take advantage of it, reemployed annuitants, temporary appointments, and interns, but everybody else was eligible. Again, the primary incentive is that the employee was placed on paid administrative leave within 4 weeks of signing the agreement until their employment with the agency ends, which again could be no later than December 31st, 2025. And while on paid administrative leave, the employee continues to receive all pay and benefits until their retirement or separation date. Now, if at the request of NCUA management, an employee agreed to postpone paid administrative leave, that employee would receive in January of 2026 an additional payment that equals half the employee's annual salary, prorated for the period between signing the agreement and when the employee was ultimately placed on paid administrative leave. But if the employee did not agree after being asked, they were then placed on administrative leave within the 4 weeks as the program outlined. Also, participants in this program, if they were eligible for VERA, voluntary early retirement under OPM standards, that was made available to them as well. In addition, employees who participate in the NDRP will not receive a performance appraisal or rating for the performance year ending on September 30th, 2025. This is because they'll be on paid administrative leave for a significant portion of the rating period and will then be departing the agency. To account for any performance-based lump sum payment they typically would receive in January each year if they had remained an employee through the end of the year, the program also specified that for employees in the DRP whose last day of employment is December 31st, 2025, that they would receive a lump sum payment in January of the amount applicable for their position. For the vast majority of the DRP participants, this payment is $15,000. There are 17 executives in the DRP, and they receive somewhere between $29,500 and $42,500. And those amounts are consistent with what they would typically receive had they received a performance rating for the year. The NCUA's DRP was modeled off of OPM's DRP, which also has been referred to as the fork in the road. OPM's program generally provided for employees to be placed on paid administrative leave soon after opting in and through September 30th, 2025. And that equates to roughly 7 to 8 months of being on paid administrative leave before departing federal service. Given that NCUA's program wasn't going to be operational until a little bit later, we used December 31st, 2025 as the end date, which also provides roughly 7 to 8 months of paid administrative leave for most of the NCUA participants before they depart federal service. And again, it would also have the departures completed within the NCUA's 2025 budget year. For option 2, the NVSIP, employees who are or will become regular retirement eligible, not early retirement eligible, regular retirement eligible, by December 31st, 2025, were eligible for this option. There are a few exceptions, again, in probationary employees, reemployed annuitants, student interns, and temporary employees and board members. Please note, this option does not include paid administrative leave. Instead of paid administrative leave, they receive the $50,000 payment once they depart. Each participant in this option who remains an employee through December 31st, 2025 will also receive in January 26 any applicable merit lump sum payment as typically calculated for merit pay raises based on their performance rating for the 2025 performance rating period, subject to any limitations in effect when that's determined and paid, which is normal course of business for that. If we go to slide 7. This slide shows the results of the VSP to date. The enrollment period, as I noted, has ended, and the time allowed for employees who enrolled to sign the applicable agreement has also ended. However, there are about, I think it's down to about, yes, it's about 14 employees who are still in the rescission period. So once they sign under the law, if they're 40 years old or older, they have 7 days to rescind. And so there's about 14 employees who are still in that 7-day window. So the exact numbers won't be determined until that 7-day period runs, which I think it'll run through Monday, this coming Monday. So you can see how the results played out here. We had 297 that enrolled who were eligible. We had a couple try to enroll who weren't eligible, but 297 that were eligible that enrolled, 40 rescinded. And that leaves a net of 257, but we have 14 still in that rescission period. So we'll end up somewhere between 243 and 257 once that rescission period ends this coming Monday. And in terms of breakdown between the two options, the NDRP or the NVSIP, it was running at about 70-30, 72% for the DRP, 28% for the VSIP. All right. One other thing I wanted to note while we're on this slide, we had, so it's about 72% of the 250 some that are in the program. That's approximately 197 on the DRP, and of that 197, 152 are already on paid administrative leave, so they're no longer working. They're still on. They're still an employee, but they're on leave. Also, I would point out the NCUA is not releasing individual names of VSP participants. However, the participants can choose to disclose their participation and inform people of their departure and that their departure is related to the VSP. And to our colleagues who have or are departing, we extend our heartfelt gratitude for their service to the United States and to the credit union movement, and we wish them the best in the next chapter of their lives. We can go to slide 8. The departures do create some interim challenges, which we'll talk a little bit about. This slide shows the headquarters, a central office, had a higher level of participation. The overall average level of participation is roughly 24%. Now that's based on enrollment. We have, again, we had a few rescissions. These numbers are based on enrollment. So the headquarters had about a almost 31% enrollment level. Headquarters tends to have more senior staff, people who've been around a little bit longer, so that's somewhat to be expected. The field, the regions and ones, a little bit below the average at about 20%. Again, overall, the impact to the NCUA is manageable. And I just want to emphasize, we will be able to manage the impact associated with the staff departures and have already started measures to do that.
And Mary, on this one, the central office had greater than non-central office. And the central office is also where the growth has been in the last decade or so.
Yes.
Right?
In terms of primary growth in headcount.
Yes, I've heard that from people out in the field, that, boy, y'all spend a lot of money at headquarters. And that happens with a lot of entities. They get top-heavy, I guess.
So, we're going to manage through this with modest and sensible adjustments, for example, to the exam program to make it even more risk-based. We will maintain a solid examination program. We'll address key leadership and management gaps as needed over the coming months and are already in the process of doing that. Also, we will provide support to a few of the offices that have very high departure levels. There's a couple that do, to ensure continuity of operations, and we'll do that through details, non-competitive reassignments, and some temporary promotions, as well as reprioritizing work and all of the other measures we've already talked about. And some of our most seasoned and experienced leaders, managers, and experts are participating in the VSP. So although we'll be losing some institutional knowledge, to be sure, we are confident the next generation of the NCUA's workforce is up to the challenge, and we appreciate the opportunity and will appreciate the opportunity to take on expanded roles and responsibilities. If we can go to slide 9. This slide shows where we started in 2025 in terms of authorized positions. It was 1,255. And head count, in January, we had an actual head count of 1,214, including the CLF employees. As of May, and of course that number varies from day to day, but the actual head count's down to 1,203. And if you deduct the 152 employees already on paid administrative leave, as I had noted on the prior slide, that leaves 1,051 employees currently still working day to day at NCUA. So if we have somewhere roughly 250 departures overall on the VSP, and again, that exact number will be somewhere in the 240 to 250s range once we get through the rescission period here. But just taking 250 as an average of that, you deduct that from the head count of 1,203, you're left with 953 employees. So we're expecting to go into 2026 with roughly that number. Because again, while they might be on paid administrative leave, they're still an employee through
Still on payroll.
Yeah, through the end of the year. And the VSIP is the same, right? They're working and they're still on the books. So that's how that'll play out. In terms of just percentages, if you are basing it on authorized positions, and we're down to roughly 953 going into next year, that's a 24.1% reduction in positions and a 21.5% reduction in head count. And I just want to note, actual results may vary a little bit depending on any hiring authorized for the remainder of the year, as well as any additional attrition that occurs that isn't related to the VSP. If we can go to slide 10, I think that's where I'm going to turn it over to Amanda.
Thank you, Larry. In terms of hiring, we're still operating under a hiring freeze that runs through at least July 15th, 2025. And there are very few exceptions permitted for the freeze. But once the hiring freeze is lifted, any new hiring will not exceed 1 for every 4 departures. And it's important to note most employees in the VSP generally are not separating from NCUA employment until December 31st, 2025, as Larry had mentioned. So other than for rare exceptions, we won't be able to add to headcount until those actual departures start occurring. Also, any new hiring will only be in the areas of the highest need and with the goal to align new hiring with the desired future state of the agency. While we work through the transition in 2025, we are able to use details, non-competitive reassignments, and some temporary promotions to fill gaps and reallocate personnel to the areas of highest need. But I just want to reiterate that NCUA will not announce positions for permanent selections until the hiring freeze is lifted, and then we have the capacity based on departures. Slide 11, please.
So, sorry, just a minute. The hiring freeze as we sit here is July 15th or something, right? In theory, if they don't extend it, we could start hiring on July 16th.
Based on the capacity of people that have already left.
Off payroll? or
Off
what?
payroll.
So them not extending the hiring freeze doesn't help us much, right? Because they're on payroll to December 31st?
Many, most
The
of it.
majority.
Yeah, most of the time. All right, so in terms of actually getting people back on board, I know you're gonna get into it, it takes a while. Now, and the prior Trump administration, they had hiring freeze, it lasted about a year. It went, so let's say they extended for another 6 months, all right? We could start, the federal process takes a while, and we're gonna get into that. That's why our current colleagues can't necessarily automatically get a promotion, because that, there's a whole federal process, you have to put it out publicly, and, but we could start interviewing people. Let's say they extended it another, to January, right? We could start posting jobs and interviewing people this fall, because it takes a while to get people in the federal system, right?
I
Trying to think
don't-
when I'm gonna have new colleagues.
Yeah, I don't know if the freeze is for announcing or hiring.
We'd also want to be careful that you were confident enough that the hiring freeze was going to end.
No, that's right, that's right. All
Right,
right,
so-
we wouldn't even bother doing this unless they said, we're extending it to January, and then at some point said, it's gonna be lifted. Because I do know that the administration knows that, they know that you can't have 20%. They know that since we're not picking the 20% who leave, you're going to have departments with huge holes and you've got to fill them and, that sort of thing. Please continue.
So there are going to be cost savings from the hiring freeze and reductions in contracts and travel, including some small savings for those on paid administrative leave. But as we've established, they'll still be on payroll until the end of the year. So there's going to be incremental costs and unbudgeted funding requirements associated with the VSP. So we don't project significant net savings for the 2025 budget. However, with a large reduction in the number of employees starting in 2026 and other contract and travel-related savings, we estimate the gross budget reductions for 2026 to be approximately $75 million. And the majority of this amount is expected to be available to reduce the 2026 budget. But the actual net budget reduction for 2026 will depend on factors like the customary pay and benefits, cost increases for the remaining personnel, any inflationary increases in other cost categories, and any new positions and investment in technology that we need to operate with the lower headcount to meet the administration's priorities or to maintain and improve services to the public. And the 2026 budget will reflect those factors. Slide 12, please. So we will continue finalizing the steps associated with the VSP and offboarding those employees. With the reduction in staffing, the NCUA is focused on an orderly transition of essential duties to ensure the agency's core mission and services to the public are maintained. We will reallocate people and resources as needed, which may result in both temporary and permanent changes to operations, including the examination and supervision program. We also are working to determine a future state for the agency. We've already solicited input from all employees, receiving very robust responses, and we formed a team to parse through this input and develop recommendations for the board to consider. Slide 13, please. The work of the group and the decision-making related to the future state of the agency will be informed by the guiding principles listed on this slide. And the guiding principles are consistent with the priorities of the administration. The increased focus on top mission priorities, identifying efficiencies and consolidating and grouping like functions will provide various benefits over time to the agency, its employees, and the credit union industry. Over time, organizations naturally accumulate tasks, functions, and structures that can lead to inefficiencies, silos, and other suboptimal outcomes. So this necessary endeavor provides a rare opportunity to revisit the agency's structure, workforce, and approaches. And we'll be able to adapt to these to contemporary needs and priorities and address longstanding workload challenges through eliminating unnecessary and low-value tasks and identifying and embracing more efficient methods of achieving effective outcomes. Many of these changes will require significant additional planning. And as the budget process begins in the coming months, we will start identifying specific actions for incorporation into the NCUA's draft 2026-2027 budget. Slide 14. So as we continue to look at future changes and ways to increase efficiencies, we've received many great ideas from staff across the agency, but we also invite other stakeholders to provide us with ideas and suggestions for ways that we can enhance our operations, including our examinations. So please send suggestions to askncua@ncua.gov. This concludes our prepared remarks, and we can answer any questions you may have.
All right. Thank you for that. First off, we should mention that this sort of thing happens every single day in the private sector. It happens at credit unions every single day. I've been through it. I was at Lehman Brothers when they collapsed, and believe me, we didn't get a deal like this. If they had enough money to pay us that severance, we wouldn't be in that situation in the first place. We were also paid partially in Lehman stock. Government employees at least don't have stock that goes to zero. Oh, the fun part about that was that it had a 5-year lockup. We were paid every year partly in Lehman stock, and you couldn't sell it for 5 years. How long was I there? 4.5 years. It was great. It was, this sort of thing happens all the time. The difference between the private sector is people in the private sector usually don't nearly get this good of a deal. And I want to mention 20% headcount reduction. We've had no layoffs, right? No straight up layoffs. Nobody was even nudged out the door, right? That is very different and it's remarkable. And I want to acknowledge that any change like this is going to have disruption and change, right? Even if we could surgically pick the 20%, you can't go down 20% employees and not have issues. So I appreciate the patience and understanding of everybody at NCUA. It has been quite a process. This may be the most important board briefing I've ever been a part of because of how long this is going to affect the agency and how many people change. From a government standpoint, this last happened, Bill Clinton administration. I don't think the Trump administration is going to, it may not get the same reduction Bill Clinton did. It was over 300,000 government employees, right? They had several rounds of buyouts. The way it worked back then was just a straight buyout. You got 25K and walked out the door. 25K today is about 50K in today's dollars. So the Bill Clinton administration had 3 rounds of this all across government. I didn't look back, see what happened in NCUA, but it's been a while since government has done this. I'll also mention that the deal that our colleagues got, it's a good one. I'm glad they, are taken care of. The White House has also waived all the restrictions on outside income while you're on payroll, other than the ethics issues. What I mean is, we at NCUA, most government employees, are allowed a nominal amount of outside income. Like if you do a dog walking service or you drive for Uber and you make $3,000 a year or something like that, as long as it doesn't involve credit unions, it doesn't have an ethical issue, you're allowed a nominal amount of outside income, right? Those are all waived. There are people across government that already are on payroll for months to come that have got jobs that may pay as much or even more than they had, and they're allowed to get both paychecks at the same time with the full 401K contributions and everything. So that's another part of this. Somebody that walked out of here on Monday can start work at a new job on Tuesday, as long as it's not a credit union. There's some ethical restrictions for a year or so, 2 years. So that's another reason it was a good deal. You can not only look for work while you're on paid leave, you can start working. You can get paid more than you do at NCUA, and you can still pocket the whole thing. So it's more attractive than at least what I went through in the private sector. So the EO, 14210, implementing the workforce initiative, was trying to drive change. All parts of the government were asked to find efficiencies. We approved these programs. My top priority was design a program to provide employees with certainty, because all 1,200-something employees wanted certainty. Because if we didn't hit certain targets, we might have to consider actual layoffs, right? So even if somebody had no interest in either one of those programs, they still cared about how it all went down. Our employees wanted to know, are you hitting your targets, because that might affect your decision, right? If you think layoffs might be coming. And we had another stage plan before layoffs. We had another retirement eligible program we didn't have to go to, but at some point there might actually be layoffs, just like credit unions do every single day. And we managed to do it without that. So certainty was a big thing, right? Making sure they knew the deal, they knew where we were in the process. And we provided numbers to everyone about how we were doing before the programs ended. So somebody, if they were on the fence and they wound up finding out that no, layoffs are not planned, and we can now move on. That certainty in this program and all the meetings we had while doing our day jobs would not have happened without exceptional leadership here and folks who conceived and implemented this entire program. To my fellow NCUA colleagues, I can still call them colleagues because they're still on payroll no matter what. Every single one had a unique circumstance to consider reaching a decision that was best for them. If you've chosen to depart the agency through one of these, I am grateful for your years of service and your contributions. Your professionalism and dedication are appreciated. We were going to do this update last month, which would have been while these separation programs were ongoing. We wouldn't have known at that time. There would have been a lot more estimates. Right now, we only have 14 people or something that we're still waiting to see if they want to take the deal or not. And that's a little over 1% of our staff, right? One benefit of doing today is we pretty much have the programs over. We have actual numbers. We have actual numbers on departures. We have actual numbers on dollar figures here, that the savings. So we're now able to talk a little bit about the future of what NCUA looks like. Again, had we done this in April, it would be a lot harder to say, okay, now what happens next? What happens after people leave? What are you going to be like? Because we had huge variability back then. So that's one benefit of doing it now versus in April. What I said from the beginning is we're not going to do the cliche of do more with less. That doesn't really work. We know we can't lose 250 people and think we're going to have the same people doing the same things in the same manner at the same intervals. I appreciate the terrific work of so many here to ensure that we've thoughtfully restructured this agency. And one good thing about this job is we have one crystal clear, mission-critical objective: avoid a major loss to the share insurance fund. We have other things to do, congressionally mandated things we have to do. We're also charged by statute with supervision and chartering, but all of those things are downstream from losing. Regulation and chartering are much harder if we have a huge loss, because then we have to, it's more expensive to run a credit union. Your cost you have to pay at NCUA would go up substantially. Okay, this happened in the banking world 2 years ago. So we've got one true north here. We're an insurer, like every other insurer in the world. We don't want to lose a lot of money, right? That's bad for literally everybody. So to that end, we've been in an agency-wide dialogue on how to protect the SIF while we restructure. Each department head submitted a draft plan to deliver excellent service with fewer people. We were all asked to envision 2 stages of this. Stage 1 is 2025, this year, since our cost savings don't kick in until next year. Right now, we have fewer people, but don't have the money. We don't have the savings yet, because they're mostly paid through the end of the year. So this is kind of, somebody called it a triage stage. So we've asked every manager, what processes you do can be streamlined, delayed, or eliminated? Many of his ideas are just better practices, regardless of whether we had headcount changes or not. A little example is it's now quicker to log on to our computers, and we're fixing our convoluted, wasteful time card process. These are small, unsexy examples, but every second matters. Plus, as you might imagine, a monopoly government agency winds up with lots of processes and methods and reports that people keep doing because someone in the past suggested it without any real cost-benefit analysis on whether everything we're actually doing right now is the best use of our time and credit union money. We already feel lighter on our feet. I feel that. And we've reviewed every threshold, everywhere there was a dollar figure. How many layers of approval are needed for what dollar figure of a transaction? We may well change those back in the future. Remember, everything we do or did was done by a smart, wide-awake, sober person who had that idea, so they're not crazy bad ideas. It's just we don't have market forces to make a structure, so a lot of things we keep doing because that's how they were done. We may change a lot of these things back. Remember, some of them are just pause, because next year we have a good thing called money, and things you can solve with money by hiring 1 out of 4 back. So let's call it 250 leave. That's 60-something we can hire back. That's going to take a while because we didn't pick the 250. So you're going to wind up with holes. It's not in certain areas. Well, I mean, you're going to wind up with 250 holes. But some of that we can change by changing what we do and how we do it. But no matter, we're going to need some help. But that's going to take a while, the federal government hiring process. I want everybody to know the priority when we can hire those 60-something back. Remember, we can hire 1 for every 4 that left. But we can't do it until the hiring freeze is over. And we can't do it until they're off payroll. The priority is going to be what everyone guesses it would be. Out in the field examining credit unions. That is what we do. Making sure we don't take our eye off the ball. Also, examiners are hard to get. It's hard to find people in this country. The people who have a skill set examining America's banks and credit unions, it is hard to find, and it takes a lot of training even while they're here. Nothing against other job functions, but like HR, IT, they do great work, but you can find them at other agencies. You can find them at FEMA or the Pentagon, and you can find them at the private sector. People who examine banks and credit unions from an insurance perspective is a very narrow skill set, and it takes a while. So focus on stage 1 right now, right? We're doing less with a lot less, not more with less with less. We changed what we're doing. We're removing work. I asked all the managers, I'm not asking you to do more work, I'm asking you to do less. What is an epic pain that you do that takes longer than it should that we can do in a different manner, right? Remember, who does what, in what manner, how often? Those are the 4 knobs you turn, okay, to get us back to agency of 950 people, which we were not that many years ago. Stage 2 starts in January, where we have millions of dollars in cost savings finally kick in. Now, a lot of that cost savings deserves to be returned back to the folks who earned it, credit unions, in the form of a lower bill next year. But there's other uses for it. Now, we don't want to be penny wise and pound foolish. We still have over $2 trillion in assets to insure, right? We don't want to just cut costs and give them money credit unions and then cause a bigger problem. But we do have, but it is still true that we should give a chunk of that back to credit unions. Because it is absolutely true that a great way to ensure credit unions are financially stable is to give them back some of their money. So beyond that, in January, with the rest of that money, we'll be able to fill holes at NCUA with new technology. We've got a bunch of things here. This is a better way to do it. It's indisputably, it's better, it's faster, it's cheaper, but it's going to require spending some money up front, okay? That's the money we get in January. So we can hire some contractors, we'll have new hires, we'll have some technology. And beyond asking at the time, 23 department heads for their visions of what they should do, and we've updated their performance plans in certain cases too, to make it very clear that 2025, what you're supposed to be doing and how you're supposed to be doing it is different than what we thought when we wrote people's performance plans last year. But beyond the department heads, I've been on a mission to get suggestions from everyone here. I sent out the Ask NCUA link to our all-staff email, and I asked that the tool be changed to allow attachments. These should just be text. Someone could say, see this screen right here? You know, this is annoying, this should change. I now have an Ask NCUA folder on my Outlook email with all kinds of efficiency ideas, plus a few we politely disregarded. For example, we're not going to put the thermostats at 78 degrees in the summer. We have moved or will move on every single good idea, right, which most of them are. And for that matter, I want to remind the public that anyone can use the Ask NCUA tool on our website. Just Google it. You can submit anonymously if you wish. It says you want to put your name or not, right, your email. So, so please, anyone out there, send them in, Ask NCUA, here's what you should do. Here's what we do at our credit union. Throw it out there. What's overly burdensome? What does the public feel is overly burdensome from what NCUA does? What could be done quicker or better? Or what do you think NCUA is doing where the juice isn't worth the squeeze? We cannot afford to ignore any good ideas, certainly not right now. To that end, I want to also invite the public to review NCUA's strategic plan, okay? This is the one we put out. We do this every 4 years, okay, or a change of administration, okay? This is the one we're operating under, 2022 to 2026, okay? Why do I ask? Because this is an important document. We use it as a true north for those years going forward, and we're going to be updating it soon. The next one will be 2026 to 2030. So I encourage you to provide feedback on what you think should be in our next plan, okay? You can look at the current one, it's available for guidance, right, on what sort of things are in here or not in here, okay? And you can use the Ask NCUA tool, again, just Google it, it's public. More to come on that, but we're gonna be revising this year, okay? And finally, for the majority of the 950 of my colleagues who are staying here, I look forward to working with you as we reimagine the agency's future. And based on the excellent suggestions for improvement we've received from employees, I have every reason to believe that the future is bright, both for the agency and for the credit union system. I'm proud that some people who signed up for one of these things, and then we did all these ideas and asked the managers, how are you going to change the job? How are you going to change the rules? Said, wait a second, I want to stay now because the job is better than I thought it was. You took out a bunch of the pain points and left me with the good stuff, right? Meaning it's not going to be an extra hassle to do that. We're not going to have all these time lags. So I'm very proud of that, and to me, that was a market indication that we were doing some of the right things, right? Because understandably, if you don't have the right people working on this, you could have 950 people trying to do exactly what 1,217 were doing, and that is not fun for the remaining people, right? So I'm glad some people said, whoa, I see what you're doing. I see the changes you're making. Actually, I want to stay. This is a different job than I thought it was going to be. So I'm proud of that. Some questions for you. We talk about our core mission. You guys use that phrase. It's in your presentation. Can you just elaborate? When you say core mission, what are you referring to?
So our mission statement is protecting the system of cooperative credit and its member owners through effective chartering, supervision, regulation, and insurance. So of course, we're going to achieve our mission. When we say core mission, you know, our focus in the shorter term is on the things that matter the most to achieving that mission, the high value, you know, high impact, juice is worth the squeeze type activities. That's really what we mean by that. And of course, as you indicated, job number one is making sure the share insurance fund is safe and sound. But we also are going to satisfy all of our other statutory obligations, of course, and we're going to maintain our service to the public, you know, credit unions, consumers, members, that sort of stuff. So of course, we're going to do all of that. We're just going to focus on what matters the most and do real prioritization.
All right, so we said, let's review. I think if anybody's following this, the most eyeball pop number in that whole thing is 75 million. That, we spend about 400 million a year, right? So that is a big chunk of our budget, call it 18%. Credit unions should expect to get some of that savings. It's right, it's fair. It helps with our job, since credit unions that have more money are more likely to be stable. But can you walk through again? We don't know exactly, obviously, I know that, but what happens to that 75 mil?
So I think slide 11 said the estimated cost savings for 2026 would be $75 million gross. However, the actual cost savings in 2026 is going to depend on a variety of factors. And I talked a little bit about some of them, but as you said, in 2026, if we're able to begin new hires, then that will increase payroll, likely not to the tune of the 75 million. But also any potential technology investments that we
Yep.
need to make, specifically to subsidize the lower headcount.
Yeah, a lot of the ideas we got, some of them we've already implemented, but some of them were like, that's cool, you're right, but we have to write a check to do that. It's worth it, it's gonna save tons of hours, it's gonna make the job better, but it costs money.
Yep.
Yep.
And then there's just general inflationary cost increases. Most notably, I think the largest is for pay and benefits. And money is important, but we also expect other changes that are going to benefit the credit unions in the form of improved processes, accountability, and communication as we work to streamline internally and eliminate those functions that are low value.
Okay, and even though everybody at NCUA who's an employee went through the federal hiring process, we've gotten some questions that say, wait, one of the reasons I stayed was to get promotion opportunities, some of the retirement eligible people, are left, so now there's a clear path for advancement. What's up, guy? They've asked that. Where's the job bank? Where's the listing? How do I do it, right? Can you talk about that, speaking to our colleagues who many of them should get promotions? There are opportunities. We want them to do it. Why isn't that happening yet?
So as we mentioned, we really can't do any hiring until the freeze is lifted. And for the most part, that includes promotions, because I think you had mentioned promotions are filled through the competitive process.
Right.
And that includes announcing the
So
position.
even if we're not increasing headcount, the hiring freeze still stops that. Because it's still a job opening filled and the hiring freeze affects that, right? I
Yep.
think some of our employees, that we need to make that clear.
Yep.
Yeah. They think, why can't I fill that? It's not increasing headcount. It's just me going to there.
Yeah.
You can't, we're not allowed to. Yeah. All
Yeah,
right.
and I would just add to that, we do have some, and we did coordinate with OPM, some ability to do on a limited basis temporary promotions as a bridge, right? To fill some immediate gaps, to bridge to the future when we can do permanent hiring. The other in consideration is, of course, as we reimagine, the future state for the agency, that will also likely come with some structural changes. If we go back to the slide that showed the guiding principles, I think it was slide 13, maybe. We are looking to have some streamlining of the organizational structure to also create efficiencies. And so when you start doing the permanent hiring, you're gonna want to do that on the what's the future state as opposed to the current state. So that's another variable to keep in mind.
Temporary, I think it was 120 days we can do, right?
Then we can do more than 120 days.
Oh, okay. I think we have to,
We can do details, we
Yeah.
can do competitive reassignments, we can do temporary promotions. We can do pretty much on a unlimited basis, up to temporary promotions up to 120 days. It's the over 120 days that we have to be more judicious about.
And 120 days, that's, a third of a year.
Yeah.
If you temporarily do a job that paid 30 grand a year more than your current job, you do it for a third of the year, right? You're doing a job for somebody who got paid 30 grand more than you do in your current job. It's fair to say, where's my 10 grand,
Yeah.
right? And do we have the ability to pay them at that salary?
So when we do temporary promotions, we generally,
Yeah.
it comes with a pay increase. We also, if somebody is on detail to a higher graded position, we also have the ability to do what we call special act awards to
That's where
to
you're not
recognize
gonna
that
sit down
contribution.
and review every sort
Yeah.
of bonus authority I have. And there are people who already deserve, in the government, bonuses. It's not like Wall Street where more than half of our pay was our bonus, but there are people who already deserve these. And the people who created good ideas, who deserves $1,000? Someone that saved you 100 grand. All right, and last question. The thing that credit unions would care about, what's up with the exam schedule? Okay, we made changes, we had to.
Yep. So we made several risk-based changes that provide regions with flexibility to allocate exam and supervision resources where they're most needed to ensure safety and soundness. The changes prudently extend the maximum exam timeframe for credit unions meeting certain criteria, and we also relaxed some of the criteria for credit unions to be eligible for the extended exam cycle. So specifically and generally, credit unions with assets greater than $1 billion and less than $15 billion in assets that are well-run and well-capitalized will be examined every 12 to 18 months, or even out to 20 months for those with net worth ratios greater than 10%. Well-run, well-capitalized federal credit unions with assets less than $1 billion will receive an examination generally every 14 to 24 months. Smaller federally insured state chartered credit unions are going to receive an NCUA examination as needed, and that's going to be in coordination between the region and the state supervisory authority so that we can maximize our resources between the two agencies. All other credit unions, so generally those that have less favorable composite CAMELS ratings, lower net worth, or those that have been chartered for less than 10 years, are going to receive, I guess, what we call an annual examination or every 8 to 12 months. And I will just caveat that examiners do still have the ability to start an exam before or after these timeframes with regional management approval. And I'll also plug that on our website, on the Exam Flexibility Initiative webpage, we do have graphics that walk users through kind of where they would fit in and what the timeframe would be for their credit union.
Gotcha, all right. I think we're left with one major variable that's outside our control, and that's the hiring freeze. Because we are going to need to hire some good people to help, and that is the number one variable, right? Even if we have to wait till payroll cycle ends at December 31st, that's still not a variable. We know when it is. The hiring freeze is from my standpoint, is the one thing that is still an unknown, that is outside our control, that affects. But beyond that, I think we're doing a great job of, 140 million credit union members know that this agency is operating full steam. In some ways, it's going to wind up better, and it'll definitely be cheaper. Thank you to you both. All right, we've done our two formal agenda items. Let me make one other point. I'm obviously the sole board member sitting at the board table today. It's been over 20 years since a sole NCUA board member chaired a board meeting. I think it was 2001 last time. This change in the board's composition has understandably raised questions from stakeholders and media, but no matter what the board looks like, the NCUA will continue to fulfill its core mission, as well as to continually seek ways to improve our effectiveness. The NCUA leadership team, myself, are equipped with the required authorities to continue protecting the system of cooperative credit and its member owners through effective chartering, supervision, regulation, and insurance. Nobody has ever lost $1 at NCUA insurance. Nobody has ever lost $1 with federal deposit insurance. We're coming on 100 years of that, and nobody's going to lose any money anytime soon in that, that's for sure, okay? We've now reached the end of our agenda today.